Welcome back. We've got no Justin here today. It's just me. So we're all going to have to make do. Yesterday was a big day for the rest of the world in understanding what the Trump administration is looking to do with respect to tariffs. Yesterday brought the whole world into the tariff party. And I don't know how many of you watched Donald Trump stand up in front of the world with a big, what looked like a high school project piece of Bristol board indicating what the tariffs that were going to be levied on every country in the world were going to be. Not every country. Russia and North Korea have been saved from the tariffs, oddly enough. Today we're going to talk about how the tariffs are going to impact mortgage rates and interest rates in Canada. I know that we talk about this a lot, but it is really the number one main driver of what is happening in the Canadian economy right now. It is affecting the Canadian election. It is affecting Canadian interest rates. It is affecting Canadian jobs. It is affecting everything. So I will just say, first off, that I think that the fuse on the tariffs is now shorter. I think that by introducing tariffs to every single country in the world, save for a few, and the response that the stock markets around the world have had to these tariffs that were just introduced, how dramatic that has been, will lead the current administration to start negotiating faster. And I think we're going to see solutions to some of these tariffs. And I think maybe this is wishful thinking, but I think that the relationship with the United States and Canada and the United States and Mexico will improve now that it is important for the Trump administration to have some clarity with at least a few of its trading partners. I could be wrong. But it's starting from some of the things that I'm seeing, it's starting to feel like the tariff problem for Canada may at least have certainty. Like we may actually have an agreement in place sooner rather than later. And that certainty will help our economy and our labor market. Let's pull up the bond yields chart first to have a look at it. As we all know by now, 5-year fixed rate mortgages are derived from the 5-year Government of Canada bond yield. Bond yields are, at the time of us filming this, which is Friday, this will probably come out Saturday, are about sub 2.4%. And that is driving a mortgage market right now that has 5-year fixed rates lower than I have seen them in quite some time. 5-year fixed rates as low as like 3.6, 3.7% in some cases. Again, depending on whether the mortgage is insured or insurable or not insured. But there are some great rates available for 5-year fixed rate mortgages. That being said, we have the Bank of Canada coming out on the 16th of April, and they're going to make a decision as to whether or not the overnight rate and therefore the prime rate should drop. Just to let you know where we're at right now, the overnight rate in Canada is 2.75%. Prime rate is 4.95%. We have been saying for a while that by the end of 2025, we think the prime rate is going to start with a 3. So 1 percentage point lower from where it is right now, meaning the overnight rate would go to 1.75%. That is looking more and more likely, especially since the jobs report we got out this morning, which was no bueno. I'm going to pull up the probabilities for calendar year 2025 and where economists believe the Bank of Canada is going to go with the overnight rate. And we're going to put it side by side with where they thought the Bank of Canada was going to go before the jobs numbers just came out. Let's pull that up now, and I'm going to walk you through it. So on the one side, you can see that we were previously at about a 43 percentage point chance that we were going to see a change to the overnight rate for the April 16th Bank of Canada meeting. Now, I will preface this by saying that we're going to get a CPI number out just before that Bank of Canada meeting. But you can see that before the jobs report, the abysmal jobs report that we just got out, there was a less than 50% chance amongst economists that are surveyed that the target rate was going to be dropped by 25 basis points. So taking us from the 275 to a 2.5, taking the prime rate from 4.95 to 4.7%, and taking what your variable rate, which is maybe, hopefully, prime -1 to 3.7%. Now, since we got the bad jobs number, that has gone up to 61.5%. Now, these numbers change. You can also see that there are probabilities that have been adjusted throughout the year. So it takes you all the way down to December 10th of 2025, which is the final Bank of Canada meeting out of the year. And there is a 99% chance that we are 75 basis points. So 3 cuts off by the end of the year. And that has changed from what was kind of looking like a two rate cuts, 50 basis points off. Now, I don't know still whether April 16th is going to bring 25 basis points off of the overnight rate. What I do know is that it is not going to affect real estate prices. At this point, the consumer confidence in Canada is so battered, and the listings in the GTA, you know what? Let's pull up one more chart quickly because I'm going to speak a little bit about real estate, and then I'm going to jump back to the conundrum that the Bank of Canada finds itself in. So, great article in Better Dwelling. Better Dwelling is very bearish on the Canadian and the Toronto real estate market specifically, but Canada in general. And if you scroll down just a little bit more for me, boom. Okay, so you can see that TREB real estate sales versus new listings for the month of March, as it is compared back to 2014 here. Sales are not looking good. They are extremely low, lowest sales we've seen in a very long time in Canada, and inventories are skyrocketing. So people are listing their property. They don't care that the market sucks, and no one is there to buy the real estate. This trend will continue, and 25 basis points is not going to make a difference in April. So what is the Bank of Canada to do? I don't even know that 1 percentage point of a drop in the overnight rate and the prime rate is going to have a dramatic impact on sales. It may bring down listings because it may remove the necessity for a lot of people. Right now, a lot of people feel they absolutely need to sell their real estate because they just can't keep up with the payments. And as we see more uncertainty in the job market, we're going to see that play out further and further. And 25 basis points isn't going to make a difference. So to dive into what the Bank of Canada has to do right now, and we've spoken about this before, we're entering in globally for sure, Canada specifically, we're entering into a period that is very likely stagflationary. So that means that inflation will exist in the economy because of the tariffs, because of the weak Canadian dollar. So the price of goods will increase, the goods that we consume, but we won't have growth. In fact, we'll have very stagnant growth. And as growth either levels off or continues to decrease and inflation is a threat, the Bank of Canada is in a really tough position. They have to balance fighting inflation and stimulating growth simultaneously. We know that the Bank of Canada's primary target is to have a 2% growth rate in the Canadian economy. That is going to be very difficult to achieve. Now, the one thing we should consider about inflation, and I'm so reluctant to say this because if you remember what got us into this, I mean, not the tariff problem, but what got us into the problem of the very high interest rates was a Bank of Canada that firmly believed that inflation, when it was being presented just kind of after the COVID stimulus and the economy started coming out, they believed that inflation was transitory, was temporary. And what I'm going to tell you now is similar, but it's for a reason. So I think that this tariff impact, this weak Canadian dollar impact on inflation will be temporary. And the reason why I say that is because of the weakening job market. So in order for inflation to become pervasive in the Canadian economy, or in any economy for that matter, goods have to increase in price, and that has to force wages to increase. And when wages increase, that creates a cyclical, increasing inflationary pressure, right? Price of things goes up, wages go up. When wages go up, you have to increase the price of the things again. And it creates this kind of inflationary death spiral where inflation kind of keeps going up and wages have to keep going up. And that creates a ton of uncertainty in the market. What we're dealing with right now is a one-time inflationary shock. And because of a weak labor market, we're not going to see wages rise. So we're going to be in a really tough position. We're going to be in a position where we're not going to increase, companies aren't going to increase the amount that they are paying their labor on a one-time price shock. So people are going to be more strained, and it's going to create a further drag on growth. So this argument is just, I'm making this argument because I hear so many people and I read so many articles about the Bank of Canada is totally stuck because if they drop interest rates, inflation is going to shoot up. The Bank of Canada is aware that inflation is going to go up, but they're also aware that it's very difficult for that inflation to be sticky in the economy right now. So I think what we're going to see is a Bank of Canada that will be aggressive with rate cuts. On April 16th, I don't know whether we're going to see 25 basis points or not. I'm not as confident as the 2% chance that you're seeing on that chart. But I am quite confident that we will see 75 basis points to 1 percentage point lower on the overnight rate by the end of the year. I think that there's obviously variables at play. I would just caution the Canadian consumer that we're in for a rougher patch. Consumer confidence, all-time low. We're in for a rougher patch. We're in for a patch where wages aren't increasing, employment's dropping, and prices increase. So households are more stretched. I read an anecdotal article the other day that more people are bringing their lunch to work. And that's a bad thing, right? Reducing consumer spending, slowing the economy down. But it's probably what we should be doing. And the only bright spot, and I do see a bright spot on the horizon, is I believe that because we shortened the fuse on these tariffs, because the administration in the United States went after wholesale everyone, there's going to be pressure on them to create certainty in at least a few of their most important trading relationships, Canada and Mexico. And as a result of that, if we can bring certainty into the relationship of trade with the United States, I get it, right? Like we got to drop interprovincial trade barriers. We got to start trading more with the EU. This is fantasy, right? Like it's going to help us, but it's not going to help us now. It's not going to help us in 2025. It's not going to help us in 2026. It's going to help us as a country in 2028, in 2029, going forward. These are necessity things that we must do for our medium-term growth as a country, things that we can do to really make Canada amazing. I'm hesitant to say make Canada great again, but in the shorter term, certainty in our trading relationship with the United States will create such a fertile ground for Canadian growth. We're going to be left, I believe, by the end of 2025 in a situation, this is my prediction, where we have tariff certainty, if not the tariffs, perhaps even no tariffs, reaching a point where Canada and the United States are trading far more freely. There may be some casualties of that. I mean, hopefully, Canada realizes that we don't need one billionaire family controlling cheese, and we can adjust our supply chain management tariff situation with the United States, bring down some of those barriers to entry in exchange for a more fair trade for the entirety of our country and the success of our economy. But once that happens, you're going to be dealing with more trade with the United States and a backdrop of extremely low interest rates, at which point Canada could hit growth. As long as we don't take that growth for granted and we continue to affect change on our economy, that means pipelines, that means trading partners, that means accessing natural resources, we could be in a really, really strong position. All of these things are in play right now, so we've got to keep an eye on them. In the meantime, I would just say, if you are looking at doing something with your mortgage, because it all comes back down to your mortgage, we're mortgage agents, right? You've got to look really carefully at switching to a variable rate or a fixed rate. If you're in a fixed rate right now, the longer you wait in that fixed rate that's out of market, like I'm talking now 4.75 or higher, 4.5 or higher, you've really got to start looking at breaking that thing. Because as fixed rates continue to drop, your penalty increases. We talk about this all the time. It's going to be more and more expensive for you to switch out of that product. That's all I got for you today. Have a great weekend.